considerations, the due diligence process, as well as other related topics. And on February 4th, our strategic partner, Atomic Data, will be sharing their insights into technology trends impacting small businesses, including what companies are doing to adapt to a work from home reality and pressing technology challenges for the year ahead. And then join us also on February 9th at 10 a.m. when our strategic partner, BDO Harris, will lead a panel discussion on how CFOs can prep their owners for a successful exit or sale. And then lastly, join us on February 11th at 5 p.m. for a virtual wine tasting event. 5 complimentary wines will be sent to you, and a sommelier from Voluptuary Wine will be guiding us through a discussion of the key features of each wine, including the winemaking, food and music pairings, as well as other fun topics. This should be a fun social event, and we hope you can join us. And you can register for these events and more at feitwincities.com. And now I have the pleasure of introducing our moderator for today's session, Eric Nelson. Eric is the Tax Office Managing Director of BDO's Minneapolis office. Eric?
All right, thank you very much. I will take it from here. Go ahead and share my screen. I want to thank you, Nancy and Jill, for the introduction. Welcome, everyone. As Jill mentioned, I'm the Tax Office Managing Partner for BDO Minneapolis. I want to thank you for joining us today. I'd like to introduce Kevin Anderson from our National Tax Office in Washington, D.C., who will be providing our update for today. And I also have a couple of my teammates from the Minneapolis office joining us, Tyler Storhog, a Managing Director in the tax team, and Amber Ackman, who is our Local Business Development Director. As a reminder, the Q&A box will be available to address any questions that you may have during the presentation, and we'll also have a Q&A session at the end. And with that, I'll turn it over to Kevin to get things started.
Thank you, Eric. Good afternoon, everyone. Before we even preview the agenda, I thought I would make a couple of just quick introductory remarks. Had we been in person, and I would very much have liked to have been in person with you, but we know why that's not possible, I would have said a couple of things, one of which might have been designed to perhaps to incite you to throw food at me, but I'm not sure which one that would be. The first thing I was going to say is that a colleague of mine had given me something like 64 slides of dense material I could have used for this presentation, and I chose not to use them. I actually provided what is essentially sort of a detailed agenda items of topics that we'll be talking about today. And the second thing is that despite having lived on the East Coast for 25 years, I actually was born and raised in the state just to the immediate east of you. I am a Wisconsin Badger, and I do hope that I still have some of my Midwestern sensibilities about me. I was thinking about bringing my cheese head for display, but I thought that would just be rubbing it in, given that the Packers still have a chance to make the Super Bowl. The agenda is more or less in chronological order, if you will, and we may wonder why we're going back all the way to the Tax Cuts and Jobs Act enacted in December of 2017. I think there are a few reasons for that. The first is that it probably was the singular tax policy achievement of the current administration, which now has less than 24 hours to go before it is turned out of office. The second reason is that we have spent 3 years, and the Treasury and the Service have spent 3 years doing significant regulatory guidance, just implementing and filling in the gaps from that 2017 legislation. The third reason we may spend some time with it is that some of the things that were done that were, shall we say, taxpayer unfavorable from that legislation were sort of undone or deferred by the CARES Act. And the fourth reason we may be spending some time with that legislation is that some of the things that are in that piece of legislation are sort of ripe for being reversed or undone in a new administration. Keep in mind, as we'll talk about later, 4 years ago, we had a Republican president, a Republican House, a Republican Senate, and that is how they were able to get this kind of tax legislation through. Starting tomorrow, we'll have a Democratic, capital D, White House, a Democratic House and a Democratic Senate. And so I think that the direction of tax policy is going to be significantly different going forward than it was in the past. We'll talk a little bit about the CARES Act because, as I said, that was a piece of legislation which deferred or undid some of the things from the TCJA. A couple of other things from 2020. We'll talk about the elections. The most recent piece of legislation was just enacted in late December. Then we'll talk about what the new administration is considering in terms of tax proposals. And then we'll talk about what tax planning considerations might result. So I think the first thing we have is a polling question coming up.
Thank you very much. Your first polling question is on the screen. If you wish to earn CP credits today, please answer yes. If you have no clue, please answer yes, and you'll get credit anyway. Okay, thank you, folks. Thanks,
All right,
Kevin.
so we will continue. Much of these provisions should be well known to you. The single easiest but most substantive probably provision was just the reduction in the corporate tax rate for C corporations. It was 35% through the end of 2017. Beginning in 2018, it was reduced to 21%. There were corresponding changes in the dividends received deduction, and Congress managed to get rid of the corporate alternative minimum tax and caused all of the AMT credits that had been built up over the years since 1986 to be refunded. This was a $1.5 trillion tax reduction over a 10-year period, but the biggest single provision, I think, was the corporate tax rate reduction. Then we got some business related provisions which affect both corporations and individuals, coming up on the next slide. And with respect to those provisions, we had one of the other probably significant achievements, which I suspect you're all familiar with, is that Congress has toyed with bonus depreciation over the years, going all the way back to the economic recovery after the 2001 terrorist attacks in New York and Washington. This is sort of the highlight, if you will, the zenith of bonus provisions. 100% bonus depreciation beginning in September of 2017, continuing through the end of 2022, after which it is going to be phased down and then ultimately phased out. For small businesses, there is a more permanent expensing provision, but that has dollar amounts associated with it. Keep in mind as you go forward that beginning next year, as this slide indicates, R&D expenses, research and development or research and experimentation, has to be capitalized and amortized over a period of time. One of the things that the Congress did to pay for this legislation was to enact some limitations on business interest expense. Those have been incorporated into new Section 163J, and they have been the subject of probably now 3 rounds of regulations since they were enacted. So we're dealing with that as well. NOL carrybacks were precluded again from the 2017 legislation, deferred a bit with the CARES Act, and there were some limitations on settlement, deducting settlements with government agencies, and a restriction of 1031 like-kind exchange provisions now applying only to real estate. So we have another quick polling question, something which I'm actually very curious about.
Thank you, Kevin. Your next polling question is on the screen. Does the presence of 100% bonus depreciation affect your capital spending plans? Your choices are yes, significantly, yes, moderately, not a significant factor. I'll give you just a few more seconds to answer that poll. Okay, I'm going to share those results. And there you go.
I'm sure Congress will be happy to see that because nobody will, or very few of you will mind if they get repealed or cut back. Anyway, thank you. One of the things that Congress did also in 2017 was to quintuple, I think is the right word, the threshold for what constitutes a small business. It used to be 3-year average annual gross receipts of 5 million. Now it's 3-year average annual gross receipts of 25 million, which is indexed for inflation. So for 2021, if your 3-year annual average gross receipts are under 26 million, you've got 5 particular benefits under the code. You don't have to use the accrual method. You don't have to use inventories, although you do have to account for so-called non-incidental materials and supplies. You don't have to apply the dreaded UNICAP rules. If you are a long-term contractor, you don't have to apply the percentage of completion rules, and you don't have to apply Section 163J. There were also some business provisions for non-corporate taxpayers, keeping in mind that there's lots of business income that ends up on the individual tax return, either through sole proprietorships, through partnership income, through S corporation income. And when Congress took a look at this scenario in 2017, they said, we're not changing the individual income tax rate that much. We're significantly reducing the corporate tax rate. So we want to make sure that business income is not significantly disadvantaged, if you will, if it ends up in the individual tax realm. So we now have this new Section 199 Cap A deduction for qualified business income. This is a deduction of up to 20% of qualified business income. So as we noted on the third sub-bullet point, if your maximum individual tax rate is 37% and you get a 20% deduction, that effectively reduces the tax rate down to 29.6%. It's a little bit less than half of the way from 35, the old corporate tax rate, down to 21, the current tax rate. So there is still somewhat of a disincentive in terms of the current tax rates from operating in non-corporate or flow-through format, but you also have the benefit of the single level of tax rather than double taxation for C corporation income. One of the other things that Congress did, shall we say, as a penalty for business income is that if you're an individual taxpayer and you have excess business losses, which are generally defined as net business losses in excess of 500,000, also indexed for inflation, for a year, you can't use more than 500,000 to offset other types of income, non-business income, investment income, et cetera. Wages, I think, for the most part, can't be offset by other excess business losses. So we had that to contend with until it was postponed. On the next slide, we got some individual income tax provisions. Already alluded to the slight reduction in the top tax rate. There were some reductions in the individual rates across the board. And again, they affect business taxpayers to the extent that income is taxed as a sole proprietorship or through flow-through entities, taxed in the individual system rather than the corporate system. One of the things that businesses have had to be concerned with in the flow-through regime is the significant limitation on state and local taxes, whether it's income taxes, real estate taxes, personal property taxes. If they were itemized on Schedule A for an individual, their limitation is $10,000 per year going forward. That was a problem for flow-through entities because tax that's imposed by the states and localities on flow-through income was considered to be an itemized deduction. So there was also a significant disadvantage from operating in flow-through form because of this limitation. Some states like Wisconsin, I know for sure, have enacted this sort of pass-through entity tax as a workaround. They say if you can impose a tax at the corporate level, even though it's a flow-through, it might avoid these itemized deduction limitations. There were also significant increases in the AMT exemption so that the individual AMT is less drastic, less draconian than it was before 2018. And finally, though, for reasons which we'll talk about probably in a little bit more detail later, many of the individual provisions will expire after 2025. So we'll go back to the pre-2018 provisions, which mean that the income tax rates will go up. We'll get rid of the limitation on state and local taxes. We'll get all of the stuff back that we used to have unless Congress changes the law one more time. And leaving the income tax area leaving the income tax area, we also have a couple of things that may be of interest to some folks. The reduction all the way to zero, which is an effective elimination of the so-called individual mandate penalty or the shared responsibility payment that was part of the Affordable Care Act. One of the things that has caused people to think about on the income tax side is that the Affordable Care Act also enacted a number of income tax provisions, the Section 1411, 3.8% tax on net investment income, the 0.9% Medicare tax on high wage earners and high levels of self-employment income. And some folks are thinking that now that this issue is before the Supreme Court, would they strike down the entire Affordable Care Act? And if that's the case, do those taxes go with them? I don't think that's a likely outcome, but it is certainly something that folks are watching. The other thing that occurs is that the TCJA doubled, if you will, the exemption amount for a state tax and gift tax. And that was also a temporary provision that will be cut in half after 2025. So there may be a rush to make last minute gifts if we're still in 2025 with this provision in effect. And then the last group of provisions would be the international provisions, probably the ones that were made permanent. They were rather fundamental changes. And so we expect them, I think, to stay without really any significant limitation. There was, as you probably know, a participation exemption, which most folks think of as just a territorial system of taxation. Income that is earned by C corporations in other countries is for the most part not going to be subject to tax going forward. C corporations are also paying, and others are paying this transition tax spread out over quite a number of years, I think 7 or 8 years in total. We've got the stick, if you will, is global intangible low tax income, which somebody cleverly put together a bunch of words so that they could say it's pronounced as guilty. That was the stick. We also have the deduction for foreign derived intangible income. That's sort of the carrot. And then we've got this other odd acronym, BEAT, base erosion and anti-abuse tax. All of those things are probably going to remain going forward. So we then turn to the CARES Act, again, because some of these things were undone or put on hold for a while. And I think that the thing that most of you are familiar with is that all of these draconian provisions for NOLs precluding the carrybacks, limiting NOLs to be applied against future taxable income at 80%, those were put on hold for 3 years, 18, 19, and 20, which you should now see that we're beyond that period of time. So for a 2021 loss, there isn't going to be a carryback for the most part. But for 2018, 19, and 20, Congress is saying, how much cash can we throw at businesses through the tax system? And they said, we'll let taxpayers carry back their NOLs for 5 years. And that freed up a lot of cash for prior years. We spent a lot of time working our way through helping clients file carryback claims, digging out these old returns. The excess business losses for non-corporate taxpayers were suspended for 3 years. The Section 163J business interest expense limitations were increased from 30% to 50% of adjusted taxable income for 3 years. There's a new employee retention credit for those of you who had so-called qualified improvement property. You've been wondering why Congress could never fix the technical glitch that they gave us in 2017 after the CARES Act was enacted. It's now confirmed that that can be depreciated over 15 years and made subject to bonus depreciation. There was a deferral of payment in the employer's share of payroll taxes, and then these recovery rebates, the stimulus payments came through for individuals whose income levels were below a particular threshold. And then, while I don't plan to spend much time on the Paycheck Protection Program loans, this appears to be a hugely popular program. It's something that segments of our firm were involved with clients, helping them to determine whether they should qualify, whether they could qualify for forgiveness. These were forgivable loans. So it's in essence a grant, if you will, from the federal government to support payroll, certain other operating costs as well. And the highlight of these things really caused us to have to deal with the income tax issues, because when Congress first enacted the CARES Act in March of last year, they said that if the loan is forgiven in whole or in part, that forgiveness is not going to be subject to tax. Ordinarily, we talk in terms of COD income or cancellation of debt income, which is subject to tax except in cases of insolvency or bankruptcy. And even in those cases, you have to pay for the exemption through giving up an appropriate dollar amount of attributes, net operating losses, basis of property, business tax credits, et cetera. But Congress said this was going to be a pure forgiveness tax exempt income. But what they didn't say anything about was what was going to happen to the related expenses. And I've got on this slide 3 different pieces of guidance from the Internal Revenue Service that came out shortly after the CARES Act was enacted, in which the service said, because these expenses are funded with tax exempt income, the expenses should not be deductible. So the service effectively neutralized what Congress had given by saying, okay, if the income is not going to be taxable, the expenses are not going to be deductible, you're back in the same position you would have been in had you simply had no special provisions whatsoever. So that's about all I can say for the PPP loans until we get to the clarification coming up. So the only other thing, just to sort of be in the interest of completeness, we did list on the next slide a couple of other pieces of legislation that Congress enacted after the CARES Act. They enhanced the Paycheck Protection Program loan a couple of times before there was even a round 2 in the late December legislation. But one of the things that I found interesting is that even though Congress didn't do this, the president, through the Treasury Secretary, directed the Internal Revenue Service to come up with this notice to use the emergency declaration to the disaster declaration from March of last year to allow employers to defer the employee share of Social Security tax. This turned out to be rather controversial because even though it permitted employers to fail to withhold the 6.2% tax on the first 4,000 of biweekly wages. So it wasn't for high income, seriously high income earnings, but it was for most folks generally. Employers could say, we're not going to withhold that portion of the employee's share of Social Security taxes, but you're going to have to pay it back beginning in January of this year. So it was a up to 4 month deferral where employees could get a little bit more money in their paycheck by not withholding the employee's share. But one of the things that made it unpopular is that the service said in its guidance that if the employee left, the employer was going to be on the hook for the balance. The repayment period was supposed to be 4 months, but then the Consolidated Appropriations Act said the repayment period is now the entire calendar year of 2021. So it seems to me that that probably puts employers even more at risk should an employee leave before the repayment period is over. So that takes us to the next polling question.
Thank you very much. This is an interesting polling question per topic. Did your company defer the employee's share of Social Security taxes for the last several months of this year? I will remind you this is the third of our 5 polling questions, and I'll give you just a few more seconds to answer this poll, and then I will share the results. Okay, and there are your results, Mr. Anderson.
All right, that is sort of as I expected, because I think that many employers decided that it was too much of a risk to not withhold and then have to come out of their own pocket to pay it back. The executive branch did direct all of its employers within the executive branch to use this mechanism. So it'll be interesting to see how much the government gets stuck with as an executive branch employer. So we're almost up to the present. This has been a little bit of a recent history lesson, but up to the present, the elections of November, which seemed like an eternity ago, this was a case where the Democrats hoped to do a little bit better by picking up some more seats in the House of Representatives, and they didn't do quite so well. They actually lost some seats, but still maintained a fairly narrow majority. The Republicans picked up at least 16 seats, as you noted. This is a little bit sort of in flux because we show 5 vacancies from the prior Congress and 5 vacancies in the current Congress. There are 5 different vacancies, and the reason we have vacancies so soon in this Congress has to do with 3 different circumstances. We have one individual who was elected from Louisiana and tragically died a few days before he was to be sworn in. We have one in New York State that is so close and so contested that it hasn't been decided. So a winner has not been declared and that person has not been sworn in. There's another Democratic, capital D, representative from Louisiana who's been appointed to the White House staff. So he'll resign if he hasn't resigned already. And there are 2 other representatives, Democrats both, who have been nominated for cabinet positions. And I suspect that when they are confirmed by the Senate, they will also resign their House seats. Then over to the Senate. Again, no big surprise. We have heard so much about the Senate, in part because the Democrats hoped they could get just a clean majority with the November elections, and they had to rely upon the Georgia runoffs that occurred just earlier this month to get to an exact 50-50 tie. And it's 50-50 because the independents, as I mentioned, caucus with the Democrats. That gives the vice president in less than 24 hours to be Kamala Harris the right to vote in the Senate to break ties. And that is what technically gives the Senate majority to the Democrats. That gives them the opportunity to appoint Chuck Schumer as the Senate Majority Leader, and all of the chairpersons, chairwomen of the Senate committees will be Democrats. This is still in flux because that also projects a little bit forward. It is my understanding that Senator Harris resigned her seat effective yesterday, and her replacement is probably going to be sworn in tomorrow. In the Georgia runoffs, the certification has not yet been completed, and they're probably going to be sworn in tomorrow or the next day. So by the time we get to the end of the week, we'll have sort of our permanent, for the next 2 years, 50-50 Senate. The reason that that's important is that if we're looking at the potential for future tax legislation, we know that legislation in the Senate generally needs 60 votes to overcome a filibuster. The parties over the years have chipped away the filibuster and have gotten confirmations, whether it's cabinet positions, Supreme Court, lower court judges. That simply means that you only need a majority to be able to vote those forward. But on legislation, for the most part, we still have a 60-vote supermajority to get past the filibuster. Otherwise, the legislation can't move forward out of the Senate. What you will probably see this year is that there will be a one-time opportunity to move a piece of tax legislation forward through the so-called reconciliation process. And what that means is that if the House and the Senate agree to a budget resolution, which is just a blueprint for going forward on spending and tax proposals for the next fiscal year, they give reconciliation instructions to the various committees, and they tell the Senate Finance Committee, for example, that you can change revenues by such an amount. You can increase them, you can decrease them, but I suspect that the instruction is going to be to increase revenues through various ways. And if they enact a piece of reconciliation legislation, that can go forward with a simple majority, and it cannot be filibustered. The reconciliation bills cannot reduce revenues out beyond a 10-year budget window. So that's one of the reasons why you see the individual income tax provisions that were enacted at the end of 2017 will expire after 8 years, because otherwise that legislation would have violated the so-called Byrd rule and would have to have gathered 60 votes, which they would not have gotten under the circumstances. So that is the Senate process. We now move on to the next piece of legislation. Again, we're almost up to the present. This was the bill.
Kevin, real quick, if I may, we do have a question in the chat box. Why do the two independents caucus with the Democrats? Does caucus mean to side with?
Well, it is, first of all, it is their choice. We're talking about Bernie Sanders, who's probably to the left of most Democrats, if you don't mind my saying so, and Angus King, who's a little bit more moderate. When they come in as independent senators, they get to choose which side they want to caucus with, and that just means that they expect, for the most part, that they will vote with the Democratic Party in this particular case. That is what gets us to a technical 50-50 tie. They've both been in the Senate for quite some time, and their party status has not changed, their independence, but their caucus has been pretty solid. That's what that means.
Thank you.
All right, so then we have this piece of legislation that in its last breath, the House and the Senate of the prior Congress put together this legislation to do more coronavirus relief toward the end of December. And this is the one that the president said, well, I might not sign it because they're only coming up with these measly $600 stimulus checks, and I prefer that they be $2,000. And so he said he might not sign it. We had to learn about the so-called pocket veto, which is kind of an interesting thing in the Constitution. It never came to that because on a Sunday night, we were told that the president had simply signed it, so it became law. And in the middle of our holidays, we had to figure out what this legislation provided for and how do we advise our clients with 3 days left in the year. This is sort of, this is the top line, if you will, for this bill. I'm not sure if it really deserves to be put there, but it just was in order for purposes of describing what they did on the corporate and business side. There is a 2-year restoration of the full deduction. So it's not a 50% deduction for restaurant business meals, things for this year, 2021, and next year. This is supposed to revive the restaurant industry. It remains to be seen whether that will do so. I put the word clarification in quotes because Congress finally stepped in legislatively and said, we don't think that what the IRS told us about disallowing deductions for proceeds of PPP loans we don't think that was right. That's not what we intended. And so we have a clear statutory path now where if there's a forgiven PPP loan, the income is going to be tax exempt. The expenses are still deductible. So that is a pure bonus, if you will, for taxpayers. Probably not good policy, but it's what Congress wanted to do. The other thing that they clarified is that there were some other benefits from the CARES Act that they also wanted to make as tax exempt benefits. There's a provision for the payment of 6 months worth of SBA loans, principal and interest. There are grants for so-called shuttered venues. Some have referred to as our Save Our Stages grants. There are EIDL grants and advances that are all tax exempt going forward. The employee retention credit has been expanded in part because I believe it is also now available to those who receive PPP loans. There are other provisions that have been made either permanent. I mean, we have had expiring tax provisions as long as I have been around and engaged in a tax practice. They're really bad policy, but Congress can never seem to make up their mind whether a particular benefit should be made permanent or just put in the code for a short period of time. So there are lots of stuff that has been made permanent, others given a 5-year life. On the individual side, we saw the $600 stimulus payments authorized. I think that for those where there was direct deposit information, those have already gone out the door. Enhanced limitations for charitable contributions, and there was a permanent reduction in the adjusted gross income threshold for deducting medical expenses. So now more medical expenses are going to be deductible for individuals. And instead of having a 4-month repayment period for the employee share of Social Security taxes, that now extends to the full calendar year 2021. So now, with the time remaining, we can talk about what we think the new administration campaigned on and what we think they might do if they can get it through Congress, keeping in mind that there's a narrow Democratic majority in the House and just a 1-vote technical majority in the Senate. So it's going to be very difficult to get things done. I think that the centrists are probably going to have some significant voice in how these things turn out. But President-elect Biden campaigned on a platform of doing the things that are here. They include a proposal to increase the corporate tax rate from to 28%. So that is halfway back from where it came from, halfway back from 21% where it is now to 35% where it used to be. So if the regular corporate tax rate is going up, he wanted the GILTI rate to go up as well correspondingly. This qualified business income deduction for individuals, that's the 20% deduction, which could reduce the tax rate from 37% down to 29.6%. Wants to phase that out for individuals with income over 400,000. So that is going to be a cutback on for high income taxpayers. So this is the threshold for what the internal revenue, for what this incoming administration considers to be high income. Is income over $400,000. And there are a couple of other provisions for businesses that deal with outsourcing incentives for manufacturing within the United States. On the individual side, again, a couple of things could really hit the high income taxpayers hard. The first thing, aside from phasing out the qualified business income deduction for individuals with incomes over 400,000, he wants to tax long-term capital gains and qualified dividends at ordinary income rates. So they go back to 39.6% for taxpayers with income over $1 million if he can get to this point. He's also proposing to do something which I think is somewhat innovative, at least or new in the federal income tax system, and that is that while additional or marginal income will be taxed at the top tax rate, an additional deduction would only produce a maximum 28% tax rate. So in the current environment, if your maximum individual income tax rate is 37%, you say, what is the cost of adding $100 of income to that total, assuming it's not qualified dividend income or long-term capital gains? That's going to be $37 for $100 of income. Similarly, if I were to pay a $100 charitable contribution, I know that I could save 37 because that is benefited at the top tax rate. But now, if this proposal goes forward, an additional $100 of income would be taxed at 39.6%. An additional 100 charitable contribution would only give me a $28 tax benefit. So there will be a little bit of complexity that comes out of these provisions, but it is a way of tailoring benefits to the middle class and cutting them back for those that are at higher levels of income. I had talked already about the estate and gift tax unified credit, the exemption equivalent amount. It continues to be indexed for inflation, but it was $5 million until 2017. It was doubled to $10 million at the end of 2017. It's now been indexed to about 11.7 million. The Biden administration, incoming Biden administration, would like Congress to actually cut that back to about 35% of where it was now. So it would be smaller than less than half of what it is now, even smaller than it was in 2017 before it was doubled. And also, most interestingly, here is another proposal to go after higher income taxpayers. As I'm sure you know, as an individual employee or self-employed individual, the Social Security component of the employment taxes is maxed out or capped out at about 142 or 143. I'm not sure exactly what the number is right now. And that has always been a feature of our system. Regardless of how much you got in wages or self-employment income above that ceiling, that is not subject to the 6.2% share of the Social Security taxes. Now, what the president-elect is proposing to do is that we're going to have another instance of the 6.2% tax, which is going to be imposed on wages and self-employment income over 400,000. So we'll have this strange phenomenon where we might end up with a 6.2% tax from 0 to 140,000 plus, and then nothing from 140 to 400, and then the tax comes back at 400,000 and going forward. So the last section with the minutes we have remaining is just to talk about some of the things that you might consider taking all of these things into account, where we've been, where we think the Congress may be going. My own view, frankly, is that tax legislation is certainly not going to be the highest priority for this administration. We've heard from news reports that there are two pieces of legislation that the incoming Biden administration wants to put before Congress. One is immigration reform. The other is more coronavirus relief. So those are the two high priorities, plus getting all of their appointments confirmed through the Senate, plus, by the way, doing an impeachment trial whenever that gets going. And so when there's time, there might be some tax legislation. So this slide just summarizes some of the things you might want to think about going forward. First of which is, do you have the right entity? When we got the 2017 TCJA, we did a lot of choice of entity work for clients. We said, are you better off being a C corporation? Are you better off being an S corporation? Are you better off being a partnership or sole proprietorship? And there was, not surprisingly, a bit of a move toward the C corporation form, because if you didn't need to withdraw the earnings and give them to your owners, you could keep them in the business and pay only a 21% tax rate rather than 29.6% at the individual level, 37% or worse. The other tax that gets imposed on top of that for individuals is that if you're not a material participant, if you're a passive activity investor, if you will, in a flow-through entity, that income is also taxed at 3.8%, the net investment income tax, with which you may be somewhat familiar. But we had to take all of those things into account, whether you got the qualified business income 20% deduction, whether you intended to reinvest your earnings, whether you had shareholders who couldn't be shareholders in an S corporation. Those were all of the things that we took into account in making choice of entity recommendations or analyses for our clients. We'll probably do that again beginning this year or next year, depending upon what Congress does and when these changes become effective. If we end up with a 28% corporate tax rate, there may be a move away from C corporations and toward S corporations and partnerships, because the individual income tax rates are not, frankly, going up that much. They wouldn't be going up as much as the C corporation rates would go up. We might think about some entity simplification. We've got many clients who thought that in starting up a new business or in a new location, we'll put a separate entity off to the side rather than putting it into as a subsidiary of the existing entity, particularly if it was a closely held business. So the question then becomes, well, you've got 5 entities across your structure. Is it time to simplify them? Is it time to make them one tax-paying entity by combining them on a tax-free basis? One of the reasons that starts to make sense for taxpayers is that when Congress enacted this Section 163J limitation for business interest expense, they said you've got to apply that limitation separately at each partnership, separately at each S corporation, and then again, perhaps in some cases at the individual level. So you've got 5 pass-through entities in your structure. Each one of them is going to have its own Section 163J limitation. So we counsel taxpayers' clients on how to simplify their structure to have fewer entities. There's been a lot of work that we've done in the Section 1202 or qualified small business stock area. We do that because this has, not surprisingly, become the holy grail for investment opportunities. What Section 1202 says is that if you are an individual investing in a C corporation, if that corporation is engaged in a so-called qualified trader business, which includes some of the service professions, includes banking, financing, investments, real estate, et cetera. For most types of business operations, if you're invested for more than 5 years and you sell the stock at a gain, the gain is tax exempt up to 10 million or 10 times your basis. So to have something that is tax exempt is something that taxpayers really try to strive for if they can. And so that's one of the reasons why the C corporation form might still be relevant and useful going forward. We also talk to taxpayers about now that we have losses, or if there are going to be losses continuing into 2021, what do we do with them? You have to carry them forward now if they are incurred in years after 2020. We've got the excess business loss limitations now for non-corporate taxpayers. If you're a partner in a partnership or a shareholder in an S corporation, you cannot claim more than your basis in the interest as those losses are allocated out. And if you're a C corporation, you've got to be concerned about having a change in ownership that might limit your ability to take pre-change losses and offset them against post-change taxable income. One of the polling questions we asked earlier was whether your fixed asset, your capital expenditures were influenced much by the 100% bonus depreciation. If that's not a significant factor, then you might not be concerned about whether you place assets in service in 2021 or 22 or 23. The depreciation will be decreasing in value going forward because bonus depreciation will start to phase out after a couple of more years, and then it will be gone completely after, I think, 2026 from an earlier slide. You've got to focus on R&D expenses because they're going to be capitalized beginning next year. We used to worry a lot about compensation versus capital gains. So a lot of individuals strove to get their returns taxed as long-term capital gains if at all possible, because the tax rates were so much lower and continue to be lower. But if the Biden administration is successful in getting ordinary income tax rates on capital gains and qualified dividend income, folks might not care so much anymore about whether something is classified as compensation or other forms of gain. The estate planning will be interesting, although that's not an area where I focus very much, if at all. And that is that, again, if we go another 3-4 years at a significant $11.7 million annual exemption, there'll still be a lot of gifts being made for estate planning purposes. But if Congress and the president-elect then agree to cut the exemptions back significantly from where they are right now, there might be a last-minute rush to make gifts. One would hope there's not going to be a last-minute rush to die for estate tax purposes, but at least there might be some gifts that would take into account the generous exemptions that we have currently. And then finally, one of the things that we do is some transaction cost analysis. If you're doing deals, our goal is to find as much as can be deducted as a result of the transaction, whether it be broker fees, investment banker fees, lawyer fees, accountant fees, et cetera, et cetera. Some can be deductible, some may have to be capitalized and amortized, and others may just have to be capitalized permanently. So I think we've got one more polling question coming up.
Thank you so very much. Yes, your fourth polling question is on the screen. Will expected tax changes cause you to re-examine the choice of entity? We just had a long conversation about that.
Yeah, Nancy, this is Eric. Before people respond to that, it's interesting because there's a phrase that comes to mind after digesting all of the details and the wonderful short-term history lesson that Kevin has provided. And it really, the phrase that comes to mind is there's still time, so act now. And I think it's important to keep in mind that there's still this element of non-conformity with certain states that comes into play with respect to the PPP loans, the forgiveness, the exemption of income, the forgiveness aspects, the deductibility of associated deductions. That landscape is still a little bit murky. There's still time now with respect to tax accounting methods to be considered, all in the context of what Kevin has laid out. So as you consider this question, will expected tax changes cause you to re-examine your choice of entity? It'll be interesting to see how everyone responds, but I think we have a pretty good idea, or should have an idea of what the result will be.
Okay. If you haven't put your answers in yet, you have an opportunity to change your mind. All right, I'm going to share those results. Don't be scared.
Oh, okay. I was kind of expecting a little different, but it's interesting. I would encourage everyone to be thinking about this and consulting with your tax advisors, simply because the devil is definitely in the details on this. Yeah, Kevin, your thoughts?
I think we should counsel clients and friends not to act too hastily. Yeah. Because we frankly don't know what's going to happen. We are less than 24 hours from inauguration. And so we have no idea what the next Congress is going to look like, how receptive they will be to tax changes, which of these things from the list we put together might be more attractive than others. So I would just counsel patience in this particular area. The law through 2020 is solid. We know what it is. We don't really know what the law is going to be for 2021. So we'll wait and see.
Yeah, that's a very good point. I mean, if you go back and look at 2008, clearly we were just coming through the Great Recession. The Obama administration took pause. I mean, it was a good year or two before we saw anything really meaningful at that time. And there have been some analogies drawn, obviously with the pandemic relative to the Great Recession. And so there are I think some similarities in different views on where the future might go. But it does, let me clarify, when I say act now, I mean, pay close attention, definitely. Be thinking, be patient in this. With that, I know we want to be respectful of everyone's time, and we do thank you again. Do we have any questions now that we've reached our Q&A?
And I think
part of
there's
the presentation?
one last polling question too.
Okay.
There is one last poll, and I will push that out to our audience while they formulate questions for Mr. Anderson or Mr. Nelson. If you'd like to ask your question in the chat box or in the question box, we will be able to answer that.
No questions? Let's see. Is the slide deck still available? Yes, we will have the slide deck available for the participants. And I believe also there will be a recording, Nancy, correct, of today's presentation that may be viewed again by attendees.
That is correct. Roseanne usually posts the recorded file to the YouTube channel at FEI-TwinCities.com's website. You can find that link there.
Any other questions? Tyler, did you have any thoughts before we move on to the conclusion of our presentation?
Yeah, I think it's just around, I know we were talking in preparation of this call about potential of capital gains rates going up and overall individual and corporate rates. I think it's, to Kevin's point, there certainly is patience, but I think that certainly that it's kind of now the time to start thinking about some of these concepts. I think in more of an M&A transaction of, are there certain functions of your business or assets that maybe would or plan to be sold here in the near future that may make sense to I guess pursue more if we think that the capital gains rates will increase, or certainly the overall rate. So I think it's just that mindset of the business of kind of strategically thinking about what could change here, not making decisions, but kind of having that long-term vision of if there are changes, is your business in the right position, I guess, to take advantage of some of these permanent tax rate plays that could come into play here if we have some of these significant changes.
All right, thank you. Do we have one last call for any other questions? Just checking the chat box, or if anyone would like to speak up, you're welcome to do so. Okay. All right. Well, we again want to thank you for joining us today. We hope this has been an informative time for you. As noted on the screen, the CPE certificates will be made available to you within 7 to 10 business days. Again, we thank you, and we hope you have a wonderful day.